Describe the financial instruments available to you for running a general equity fund.
Andrew, a general equity fund typically is a specialist mandate which is trying to give the investor exposure to equity risk assets over time. And typically what that strategy would try and do is outperform a certain benchmark. It might be the ALSI, it might be the capped SWIX or the SWIX, depending on what the client preference is over time. And equity building blocks are a fundamental part of liability management over time, or trying to provide for those liabilities into the future. And as I said earlier, is that property and equity, principally being the two biggest real asset classes, are one of the only ways that investors can protect themselves against inflation, which eats away at your capital over time. And equities generally have delivered pretty good real returns. If you look at sort of the South African equity market over the last 100 years, you've got a real return from equities of around about 6.7% per annum, and property would be largely the same. So what we would be trying to do, or anyone who runs a general equity mandate would be trying to give clients access to those real returns, but also try and beat an underlying benchmark. So try and do better, for example, than the all-share index or one of those other benchmarks. And depending on the way you go about doing that will really determine on whether you are successful over time in terms of generating, first of all, those real returns, which we all need to provide for our retirement obligations into the future, but also, more importantly, whether you're successful in beating an underlying benchmark.